An international station for an international city. This is Radio 3. Money Talk.
Good morning from me, Peter Lewis. Welcome to Monday's Money Talk. It's 8:03 in Hong Kong on the 25th of January 2021. China overtook the US as the world's top destination for new foreign direct investments last year. New investments by overseas businesses in the US fell 49% in 2020, whilst China saw foreign direct investment jump 4%, helping it overtake the US, which for decades held the number one spot. On Wall Street on Friday, US stocks slipped on concerns that the $1.9 trillion COVID-19 relief bill may struggle to pass Congress and its provisions may be scaled back.
You're listening to Money Talk on RTHK Radio 3.
RTHK Radio 3.
It's 8:24. Let's go up to Shanghai and talk with independent economist Andy Xie. Very good morning to you, Andy.
Good morning, Peter.
Now, China overtook the US as the world's top destination for new foreign direct investment last year. New investments by overseas businesses into the US fell 49%, while China saw foreign direct investment jump 4%, and that's helped it overtake the US, which for decades has held the number one spot. Why is it that China is attracting this larger share now of FDI?
Well, I think that the COVID-19 has a lot to do with that. And China is a manufacturing-based economy, and FDI is mostly about greenfield projects. So the pandemic is larger under control, so projects can get going. While in the case of the United States, it's a service-based economy, and FDI is mostly from mergers and acquisitions. When the economy and the economy was down over 5%. So the urgency for mergers and acquisitions really has come down. So I think that it takes time for the US to recover.
Do you think that's going to change now under the Biden administration? Are there going to be policies that are now going to reverse that and make the US look more attractive again for foreign direct investment? Because over the years, obviously, it has a large stock, doesn't it, of FDI that it's built up over many, many years.
Yeah, I think that the issue is the pandemic is obviously not under control at the moment. It may take another 6 months. So I think that it's very difficult for foreign companies to decide to buy American assets in the service sector in the current environment. So the demand is not there. It's very difficult to implement projects. And the U.S. demand is expected to return to pre-COVID level by the second half of 2022.
Okay. And of course, we had those growth numbers from China last year. Was you surprised at all to see China end 2020 with positive growth, given that everything that's happened there, the only major economy to have positive growth last year?
Yeah, I think that obviously exports are up. Trade surplus up a lot to nearly 540 billion US dollars. The trend is still up. So the trade is a big part of it because factories got shut down elsewhere, and the world really depended on China's supplies. So that situation is not going to change in the first half of this year. China's trade surplus will jump a lot this year, possibly to like $700 to $800 billion.
But is that still going to be the case even if we start seeing a sharper slowdown in Europe because of this new variant of COVID-19, which it seems a lot of people have underestimated and doesn't seem to have been factored yet into people's growth forecasts for the UK and the Eurozone economy?
Well, it will have a lot longer impact on the economy. But on the other hand, is that the Western governments are giving out this money, helicopter money, to people to spend. So a lot of people like sitting at home and ordering stuff online. These orders usually often go to Chinese factories.
Yes, yeah, and they're trading online as well with their checks, by the sounds of it. But despite the good news, though, in China, that the one big caveat seems to be that the recovery is heavily reliant on capital expenditure and industrial output.
Yeah.
That's sort of like the old-fashioned Chinese model, isn't it? It's not really what we wanted to see.
Yeah, I think the government is sticking with the old model, and the consumption actually is down. The consumption is not just the pandemic. The household has run up a lot of debt to buy property, and that's weighing down. That service is weighing down consumption. It's here to stay. So, but the government seems to see the current strategy working. The world loves cheap goods. Even though they have to borrow money to buy, because if you buy cheaper stuff from China, obviously your factory is not going to be running and you don't have a job. But the world seems to accept China's model for the time being. The U.S. with the trade war, the trade deficit with China has increased a lot. So the world, the people love cheap stuff. And China, as long as that's the case, Chinese government will stick with this model.
So you don't think, despite the fact that it's been saying it wants to boost domestic demand, the economy to be more reliant on consumption, you don't think it's really going to move to try and change that model at the moment, or maybe it can't even do so if it wanted to?
I think China has been talking about stimulating consumption for 20 years. But the share of consumption in the economy keeps going down. Now with this debt overhang, it's becoming even harder. So what the government doing is keeping China basically a production-based economy, investment, and then it leads to overcapacity, then it leads to export promotion, and the Chinese goods remain very cheap. The world loves it, so.
So on that basis, do you see China's economic growth going from strength to strength this year?
Yeah, I think that looks that way. At least in the first half of this year, exports are going to boom, right? So I think that the 8% in the first half of the current year is very likely.
Andy, it's always a pleasure to talk to you. Thank you very much for joining me this morning. That's independent-based economist Andy Xie.
You're listening to Money Talk on RTHK Radio 3.